Um, Welcome back to the channel. So we're going to explain today why the bull market, we're really setting up for a monster bull market for the next, I think, 12 to 18 months, right? So it's not really day trading, but for the most part, if you want some clarity on the macro, what are all the fundamental drivers of the market, we're going to go over that. And currently, this is S&P 500. That's what we're staring at, S&P 500. I'm going to go ahead and take off that tag so it's not in the way of the technicals. We will go over Fed policy today, interest rates, the Fed balance sheet, the credit cycle, inflation data that came in, and kind of smooth things over, give you a different perspective so that you can think for yourself, right? Because there's a lot of talk out there of reflation, inflation. There's a lot of stuff out there. So I want to give you a new perspective, let you decide what's kind of going on, right? So we got S&P 500 pretty vertical. You can see that we're still respecting the trend. The trend is still respected regardless of the bad news, regardless of the risk into the market. The market always prices things in beforehand, right? This is the fastest, this is the smartest people in the world, really. The banks are, the banks, the market makers, they know what's coming. They can see what's coming. So the market is saying, hey, we're still strong. We're still holding anchored VWAP. We're still grinding up higher. Now, we'll go over the inflation data again. We're going to go through these slides. Just want to make sure everybody can hear. Appreciate it, Lucas. If you do have comments, jump over to YouTube because I'm going to go over the macro cycle, where we're at in the cycle, and I'm not going to look at the comments on TikTok because they disappear. So just stay tuned. All the charts that I'm going to pull up are going to be on YouTube, right? So we'll go ahead and do that. Let me get these charts ready. We're going to show you the data, not just talk, show you the data and kind of where we're at here. So first, let's start off with actually let's start off with the technicals really quick. Look at the Qs. Like, this is not a weak market. I know it seemed kind of bad, but the RSI is coming down. Their buying pressure is slowing. Although what I see is we could just keep pushing up here. It looks like we are starting to form a slight wedge, right? And I say this, you best be praying for a pullback. You best be praying that this thing breaks down because that's going to give you a better risk to reward on an individual stock. Everybody's a little different, but a breakdown would be great because the setup out of that breakdown, the setup out of a correction is going to be perfect. The more you grind up, the scarier it gets. Now, what I want to compare here today is this looks a lot like the 90s bull market. This looks a lot like the 90s bull market. We're going to go ahead and take a look at that. You see the S&P's vertical. You're waiting for the correction. You're not getting it. You're getting frustrated. If you're in, you're great. And you hear all this bad news. Support is down here at, we're going to go to SPX. Actually, support is down there. Now, this looks like a lot like the early 90s. I'm going to give you all the comparisons. We're going to look it through, right? Because you want to keep this in the back of your mind. So let's go ahead and scroll back. Let's go back to what the 90s looked like. Okay, way back here. We are on the daily chart. We got to get past the 2008 financial crisis. We got to get past the dot-com crash. And, it looks very similar, right? Because look, we're going vertical. We went vertical for an entire year here, by the way, right? The market did not give you a pullback. There might not be a pullback here. There is a lack of corrections. There was a pretty clear lack of correction during this time. And this was the whole year, right? Now, coincidentally, this was a pre-election year. The election was, Bill Clinton got elected in 96. And so this is the pre-election year, straight up, right? Earlier in the year, it was a little more vertical, but for the most part, we're in that same, we're in the same theme here. Pre-election year. And why does the market grind so high? Because the strongest cycle for an election year, these are all about cycles, are the fourth and the first year. The fourth year is a lot of fiscal promises. We're going to cut taxes. You see, Biden just did a mortgage. He's going to cut taxes for certain mortgages. You're going to get a lot of stimulus coming from the White House, right? A lot of promises, more government spending. And you might think that's negative, but the market loves it. We got that tax break in 2017. Market went straight up. Amazon benefited the most, right? So it looks a lot like the early cycle, the early 90s, where we just went vertical. Now here, we're going to actually throw on the macro term so you can see it. So the 1996 election, this was, basically the run up to the 1996 election. You also had the tech boom, PCs, fiber optics, internet, right? You had all of these technological advances hitting the market at the same time. You're getting fiscal policy, and it's just a correlation. Today, what are we getting? A new election cycle, and we're looking at chips. The chips, the Chips Act, right? 300 billion, just throwing money at this, throwing money at trying to be the dominant economy. Because in order to be the dominant economy around the world, with all the geopolitical issues, you need the best technology. You cannot fall behind, right? AI is the big driver right now. Blockchain technology, I think, is going to be the second driver in 2025. We're seeing a lot of policy and changes in the banks to blockchain. I know you don't see it yet, but you are going to see it, right? So another part of this is, let's take a look at inflation, how inflation looked, right? Because the same thing as today. Well, this isn't inflation, but this is the Fed funds rate. So today we're paused. We're at 5%. We're at 5.25%, 5%, right? In the market, was pretty vertical that entire time that rates were up. The Fed did start to cut, and I'm going to throw this on the screen. The Fed did start to cut, and what is the market expecting today? It's expecting a June cut. You guys can't see this on TikTok. Jump over to YouTube if you want to see the chart. I'm not going to move the phone around like that because I want to keep this smooth. The first rate cut is expected in June, right? This is the upper and lower limit of the rates. The first rate cut is expected this summer. Why is that? Right? Why might that be? And look, you can also see on the chart, the first rate cut started to happen, midway through in June. How correlated is that? That is insanely correlated. I just barely noticed that. The first rate cut in the 90s was in June. It was around the summertime, right? Maybe it's not perfect. It looked like they tried to cut here, but it was in June. So a lot of correlations here. Just think for yourself. That's all I'm saying. Just think for yourself. They didn't cut rapidly. They didn't need to. You hear rate cuts are negative, but that's not the truth. Rate cuts are positive, only negative when there's a growth scare, when there's a growth shock to the downside, when the leading economic indicators are negative. And right now, this economy, regardless of what you believe, yeah, unemployment went to 3.9, but that's not historically really bad. Once you spike in employment, if unemployment spikes, that's where you have that's where it's bad news. But we're not spiking. We're kind of climbing, but payrolls are up always. If you want to see this data, follow the newsletter. I got all the charts in there when I do, put them out. But for the most part, let's stick to this, right? So you got the rate cuts in June, in the summertime of 95, echoes exactly the same thing. Next, let's look at let's take a look at inflation. I got inflation on here too. This is very similar, right? This is also very similar. Let me take this off. This is your inflation rate. I'm going to bring it up so we can see it. Okay. Ooh, there we go. Okay, hold on. Come on, inflation rate. There we go. Okay, so this is the inflation rate during that time. And what I wanted to point out is I'm going to put it at 3%. That's where we're at today. We're at 3.2. We can take a look at the inflation numbers. We're at 3.2. So you can see this is the inflation on the left-hand side. So if you want to track it, basically, I'm going to bring this up to about 3%. All right. So here's 3% inflation. Obviously, before we had the run up, this was also a grind higher. This is the S&L crisis. Inflation boomed, right? Inflation went up. It came down. The market started to grind higher. This is before the election year, which happened last year, right? Before the election year, the market bottomed and went higher. And then we had sticky inflation for about 2 years, right? Right around 3%. It started to drop off. So it's not a perfect correlation, but it came back to 3%. The green tells you 3 or above is 3 or above 3%. The red is a trickle down lower. The lowest point here is 2.8%, 2.3%. So what I'm getting at here is inflation can remain at 3% and the market can still grind higher because there's other stuff coming into the market. The credit cycle is starting up. It's pre-election. You're getting fiscal dominance. Keep this key in your mind. Fiscal dominance is basically the White House is printing money. They're throwing money out to all the technology, right? They want to grow the economy to some degree, and the debt burden increases, but productivity also increases. And that's what we got in the early 90s is a productivity boom. So inflation is sideways. It's pretty sticky around 3%, and the market still grinds higher. When it really falls off, right? This was until 97. The market took off again. So this is a lot like the early 90s. Now let's go ahead and jump over to bond rates, right? These are long-term interest rates. And I think this is what we're looking at today. Long-term interest rates are what move the stock market. And I would say crypto also, not entirely. Crypto is more of the whole, fiscal cycle, but you can see bond rates had fallen, and that I would say this was the best correlation with the, election year. Bond rates came down. This means bonds were being bought up, treasuries were increasing. uh, the treasury market went higher, the bond market went higher. That pulls down rates. They move in opposite correlations. So rates came down and the market shot up on top of inflation remaining where it's at. And what are we seeing today? The same exact thing. We have technology, we have a Fed at pause at 5%. We have bond yields falling today, and we're in the fourth year of an election cycle. This all adds up to a gigantic melt up, right? And this time we have AI. The only difference here, the big difference here is that oil prices were lower back then, right? This is before oil really started to spike. They're around $20 a barrel. They went sideways, right? Stable oil prices are always good. Now we're at a higher level today, but as long as oil prices stabilize, we're looking at the same thing. As long as oil prices stabilize, right? It's stabilized between $20 and $16. Goodness, that would be very low gasoline prices. And consumers do pretty well when oil prices are lower, when gas prices are lower. But today we still have the same thing: stable oil prices. We're gonna get to the rate cut. Okay, when the rate cuts come, we're gonna get to the Fed balance sheet. Just stay tuned, because this is let's just get up to date here. This is very similar to the early 90s, and we melted up, and everybody says, oh well, there was a crash. Yeah, and the crash was in 2000, right? Okay, 5 years. What are you gonna go 5 years without gains? The key here is to get in early, so when there is a correction, it's still much higher than when you first got in. That is the key. The question is, where do you get in? I'm not going to tell you that, right? That is, you can't tell people where to get in, what to get into. But if you watch my content, you know that we've been, crypto is the best opportunity by far, bar none, not even close. So today the S&P looks the same. Let's go ahead and throw those charts up. Oil is sideways. Okay, oil is sideways, and we're going to see another chart on that. Oil is stabilizing between 80 and between like 72. If it stays stabilized, the market goes higher. If it breaks out, that's going to put a headwind against the market because energy prices go up and rates are going to go up along with that. And I'm going to throw this chart on so you can see that when this is basically bond rates or long-term rates, they're pretty much mirroring crude oil, right? Crude oil prices, they rise significantly, bond rates go up. Crude oil comes down, and it's the biggest input to inflation. It's the biggest input to prices. It's not just gasoline. It's also plastics. It's also a whole bunch of other things. Look it up, do the research for yourself. But this is a huge input. And I know inflation is high when it comes to car insurance, right? That's probably the strongest inflation right now, medical and car insurance. But for the most part, the stock market is looking at the overall inflation rate. Is the inflation rate increasing or decreasing? Are oil prices breaking out, or are they stabilized, right? Are they moving sideways? Right now, they're moving sideways. And so, just like the early 90s, how we talked about the 10-year, the long rates that move the market, the long rates are falling. So long rates are coming down, and they've been coming down, and that kicked off a lot of the rally. Now they're moving kind of sideways. Looks like they're trying to grind up, but I think they're going to roll over unless inflation comes back. We just got the CPI report, and we're going to go over CPI. Not that bad. I think it's an overreaction from sentiment view, but when it comes down to the actual numbers and the actual trajectory going forward, inflation is where it's at. It's a little sticky. Okay, it's a little sticky, but sticky means nothing. You saw the early 90s, it was sticky at 3%. Market still went higher. Productivity is picking up. That'll bring down inflation. Fed funds, we're at paused, right? We are paused at Fed funds. So what's going to come next? As soon as they cut in June, let's move this out to June. That is the next cut. June is the cut. Well, let's say we do have some volatility, which would be a blessing if you do come down because we're pretty vertical. Well, that cut is going to be another launch pad forward. And the cut's going to come because, the Fed, there's a lot of the Fed is it politicized to some degree? Well, let's just use common sense. The closer we get, the higher we hold these rates, the more likely you see commercial real estate, busts in certain areas. So the Fed's going to front run that. The Fed's going to cut before this really takes off. Maybe they let a couple things burst to let out the liquidity, to get bond rates even lower, and then they do the same thing, right? Inflation, same thing. Inflation is sideways, right? It's not reaccelerating. That's a lie. I don't know who's telling you that. Let's go to 3%. This is 3%. So we're hovering a little above 3%. I would say as long as we stay below, let's do that last high. As long as we stay below 3.4%, the market's not really going to freak out. Okay. The green is above 3.4. The red is everything below 3.4. And eventually we do fall off. So inflation is not accelerating. Okay, that is the rate of change of prices, not the actual prices. Prices always go up. They went up for 100 years. They've went up for 50 years. Prices always go up. You just don't want them to go up at 10%, at 5%. And this is the overall market, right? And we're going to throw that chart on here when we talk about it. We're talking housing is 44%, right? So housing needs to slow down, and that's a big component. But we do have evidence that housing is coming down. Shelters falling, rents are falling. Owner's equivalent rent, which is a dumb way to measure rents, is falling. And you can check again that data when I sent out the newsletter. All these are falling. Transportation costs are the real demon here. This is the real demon. Transportation costs are soaring quickly. I'm gonna throw out that month over month data. This is the year over year data. You can see everything else is cooling. Yellow is 3 months ago, red is last month, blue is this month's data. Transportation services by far are accelerating. Okay, I know, you see, look at your car insurance, ridiculous, right? But when you look at all the other components, okay, everything's pretty much cooling. Medical care is up a little bit, but it's not ridiculous. It's at 1.1% on a year-over-year basis, not crazy. Shelters still falling, right? Everything is falling except for that transportation cost. And a lot of that, it comes down to what? What do you think it is? Well, it's oil prices, because oil drives up the price of transportation, quite literally. Gasoline prices, services cost, XYZ. Okay, so the setup is perfect. Bond yields are coming down. Once these yields roll over, then the market is going to be tame. So far we're looking at, now let's go ahead and jump over to these other charts. I'll simplify this a little bit. Let's keep this up here. This is 90 style, right? 90 style acceleration melt up. We're just melting up. And you better pray for a correction here. We're praying for a correction. So what you need is, in order to look like the 90s to run up for another 3 years, you're looking at, first off, 3% inflation, sticky, whatever, it comes down, we're going higher. Falling long rates, we're getting that, we're going higher. 5% short rates, these are the Fed funds rates. Well, we're at 5% and they're due to drop in June, market goes higher. Stable oil prices, I'm hoping they remain stable, market goes higher, right? It'll have corrections, of course, but they're not going to be gigantic because there's no true risk to the market. So again, back to that first rate cut expected in June, that, keep that in mind. We're going to go over why that is expected in June. Okay, here's sticky inflation. Yes, we are sticky. Okay, we are sticky, but core is still falling every single month. Core kept falling. The inflation rate did go up a little bit, right, by 0.2 or by 0.1, but for the most part, core is still falling. That's what the Fed's looking at. It takes out energy. It's taking out the energy prices because those are volatile. And, maybe the Saudi Arabians increase oil production and crash the oil market so they can gain market share. Maybe they don't. We'll see how that plays out. Right? Or maybe we make a deal with them. But moving forward, also here it is, core down, headline up. That's what we got last month on a month over month basis. Core inflation is in yellow. It actually came down month over month. And in purple, we had an acceleration, and literally it looks just like oil. Inflation looks exactly like oil prices, right? It's almost one for one outside of medical services, outside of a little bit of what is it? Vehicles are falling, but it looks, it's really just transportation costs, to be honest with you. And we'll keep it simple there. So crude oil, bond rates running together. Now this chart is kind of showing how oil prices and CPI have been running together. They're all translating into transportation costs. I know I'm kind of repeating myself here. I just want to make sure I get them all out there. Now, here's why the Fed probably cuts rates. Okay. This is the RRP. If you haven't heard of the RRP yet, it is basically shadow support, right? Even though they're telling you we're in QT, we're not really in QT. We've been in QT QE, where they're taking credit out of the system, but the RRP facility shadow credit has been coming into the system. And I know the chart is pointing downwards, but what it's really telling us is that's money inside of the reverse repo at the Fed coming back into capital markets. That's why we didn't have a recession. That's why the stock market started to explode. This accelerated lower in January of 2023 when the market inflow started to pick up. Okay. So the point is, it's going to be empty pretty soon. When does it get empty? Well, if we try to look out, if we try to project, it's probably going to be empty by June. Wow, that happens to be the first rate cut. back in June. Now, I'm not saying it's going to be exactly June when it hits zero, but somewhere around the summer is when the reverse repo liquidity, when the credit support runs out. That's also when the market is projecting this rate cut starting in June. So yeah, keep track of this. It's called the RP facility. You can look it up for yourself, right? So you have that going on. I'm going to go back to the charts here to show you that at the same time we have global liquidity picking up. So we have the RP up here. Let me get a little of this out of the way. So you have RP coming down. Now look down the line. When the RP started to flow back into the market, look at Bitcoin just soar because that's liquidity coming into the market. Bitcoin runs risk assets, take their bid off of liquidity. So this liquidity came in, Bitcoin goes higher. In yellow, pay attention here. This is global liquidity or global credit, right? The global credit cycle is no longer moving lower. The global credit cycle is starting to pick up in response to weakening economies. In response, and this is the central banks of the U.S. central bank. This is which is the Fed. This is the European Central Bank, the ECB. This is the UK. What is the UK's bank called? I can't remember what it's called. The British bank, whatever. And China and Japan. These are all the biggest central banks, liquidity inflows, or their credit injecting into the system. Who's injecting the most? It's been Japan. It's been China. The UK hasn't done it. The US has been doing it, with the shadow liquidity. And now we're about to get the UK and Europe start to flood liquidity back in. They're going to be cutting rates. That means global liquidity or the credit cycle is starting to reaccelerate. That is very bullish for asset prices. We didn't have this in the 90s. It was just rate cuts. Now we have credit coming up and we have rate cuts coming in maybe this summer. Maybe it does, maybe it doesn't. We'll see how the inflation rate goes. And keep in mind also, this is inflation rate. You can see as the inflation came down, right? As inflation came down, credit started to bottom and come in, and rates really the bond rates really started to come down. Maybe I made that too complicated, but the point here is that the credit cycle is turning up. These are inflows to the market. Okay, cash inflows to the market are picking up. That is the biggest driver of crypto, and the stock market is net inflows, and also interest rates. Okay, and I'd say right now net inflows are even more important. And you can see as soon as those net inflows bottomed, Bitcoin really started to pick up and it just soared. So that is what we're looking going forward, is more credit coming into the system. Now, if we do, look back, let's say, okay, the rate cuts in June. Well, here's the other part. If we have a correction, that'd be positive. You want a correction, right? It's healthy to get a correction. We have a record cash inside the money market funds. Okay, up to $6 trillion of cash. Now, the reason why this cash is going into the money market funds is because the cash is literally getting paid. Okay, the Fed funds rate, which is due to get cut in June, right? The Fed funds rate is literally paying this cash. That's how it works. When you increase interest rates, you're also incentivizing people to turn to cash, to flood into cash because they're going to get paid. This isn't all investors, but this is mostly, rich, high net worth. They can stack cash and get 6%. They can, 5%, right? Whatever the Fed funds rate's at, it's at 5% short-term rates. They're getting paid on their cash is what the point is. So what happens when they cut rates? What happens when they actually cut rates? They're going to cut the earned interest on that cash. Therefore, some, if not all, not all of it, but some of that cash is going to flood into the market. You get more net inflows. Okay. So when you look at money market funds, okay, you got record amounts of cash. That's liquidity. That's gunpowder. That gunpowder will start flowing into the market as we get closer to rate cuts. Okay. As we get closer to rate cuts, the biggest, your best signal is inflation does not go higher. It doesn't go above the 3.4%. If we get to 2.9, the Fed gets closer to cutting rates. Now let's look at leverage. Okay, early cycle leverage. This is basically leverage into the market, right? The FINRA data of margin debt, so people leveraging into the market. It peaked back in January of 2021. And we got down, to the bottom when the market actually bottomed in January of 2023. It's really started to reaccelerate. Let me slow down. When the market started to reaccelerate in January of 2023, we also saw margin increase. We saw leverage start to increase. We're still at low levels, but we're early in the cycle. So we're still early in the leverage cycle here. If you got comments, go ahead and throw them on to YouTube. I'll be happy to answer your questions. Why has every recession happened on the way down to 0%? Cole Metcalf, ask me again once I'm almost done with this. I'm not sure what you're referring to, but jump over to YouTube, ask your comment. It's in, I got a link in there, and I'll give you an explainer. I'll go back and look at some of these comments, but TikTok, I'm not done yet. So let's finish this off before I hit the comments. And anyways, so margin debt, we're early cycle margin. What does that tell you? When rates get cut, that cash from the money market funds flows into equities, flows into risk, flows into crypto, flows into whatever it needs to. It could be bonds, right? All at the same time, leverage starts to pick up. We are in the early cycle of speculation. We're still early cycle. As much as you've been told, oh, it's too high, we're in a bubble. We're not in a bubble. We need a correction, but we're not in a bubble. We're not in a real bubble. We're just getting started here. Okay. Now there's some rules that got changed here. I want you guys to keep this in mind. Okay, we're gonna move over to this. Okay, bond inflows have been increasing since 2022. This is TLT. This is long inflows, long leverage accumulating inside of bonds, right? Why is it increasing? Because bonds hit a record low, and now people are piling into bonds. Well, here's what you really got to think about. When bonds go up, interest rates come down. If the market is basically moving off of higher interest rates or lower interest rates and bonds go up, that's going to bring down interest rates. So the more that bonds increase in price, the lower long-term rates come down. The lower long-term rates come down, the better the valuations increase on what? The stock market, right? Because now it's cheaper to borrow money. That's what interest rates are. So bond flows are increasing. And here's the key, right? Everybody says, well, who's going to buy up the US treasuries, all this debt inside of, that the White House is creating? Well, they're going to change the rules here. Basel 3, you guys heard of Basel 3, right? Well, now they're trying to change the rules. And you hear it's bearish, but it's actually bullish here. Here's what's happening. Remember this. The Fed has been selling US treasuries. Let's go ahead and go to the Fed balance sheet really quick. Let's turn that on. I'm going to turn the Fed balance sheet on. See if I can remember what it is. Fed balance sheet is OCL. What is the Fed's balance sheet? I can't remember what the Fed's balance sheet is. What is the Fed's balance sheet? Dang, brain poop there. Do I have it on here somewhere? Well, the Fed's balance sheet is basically the credit card to the market. It's basically a credit card, right? When it's like your credit line. If they reduce the credit, okay, then the market has less liquidity, it has less cash. But if they increase the credit, it goes up. That's the credit cycle. Right now, they're removing cash from the system. But here's what, and the way they do that is they sell US treasuries to banks, to commercial banks. Therefore, the commercial banks have to give up their cash, right, to buy those treasuries. Therefore, there's less liquidity in the market and there's more treasuries. Basel 3 is telling us that there's going to be some constraints, right? On bank requirements. So their leverage requirements, they can only leverage so much. But here's the change that's actually happening behind the scenes that isn't really being communicated clearly. The agencies should, and I have this highlighted, the agencies should revise the SLR. So that is the leverage ratio to permanently, listen to this, to permanently exclude or take away on balance sheet US treasuries from total leverage exposure. So let's put that in plain English. What they're saying here is, you know what? Yeah, there has to be a cap on how much leverage that a bank can use, right? There has to be a cap on it, but we're going to exclude US treasuries. We're not going to include them buying US treasuries. What does that do? That opens the door for them to leverage up on US treasuries. So if they leverage up on US treasuries, what happens? Bonds go higher because now they're buying up the treasury debt that is coming from coming from the White House, or all the debt that's out there, the bond market in general. The bond market is important. They're buying all the bonds because now there's no restriction from them to buying all those treasuries. There's no restriction. They can buy all these treasuries. They leverage up on it. Therefore, what happens to interest rates when you buy more treasuries? When the price of treasury goes up, interest rates fall, right? So essentially, they're trying to lower rates for the market by buying more bonds. This comes down. So what does that do? That increases more credit into the system. They can lend off those treasuries because it is like cash. It's treated like cash. Therefore, there's more liquidity. So everything is pointing to a setup that the market is going to have more liquidity going into the fourth quarter or into the second half of the year. You better pray for a pullback because this is going much higher. Who benefits the most? Well, you've already seen the Bitcoin move. And, I think it's just getting started. We're at all-time highs. record inflows into the to the ETFs, and everything is setting up pretty tremendously. So I'm going to go ahead and go to the comments now. That's a presentation, right? Uh, there's early 90s bull market, very strong. So let's go ahead and hit those comments. Let me start on YouTube. That's my primary. I want you guys to move to YouTube if you're going on there. Thanks, Metcalf, for coming over. All right, we got Biggs here. Hey, Jeremy, how you feeling about Bitcoin crypto? Still thinking of using USMNO and divergence for predicting a potential top. I feel like we have pumped super early here compared to past cycles. We have pumped early for Bitcoin versus past cycles, but it's not from retail essentially, right? This is not just hedge funds. We're getting institutional flows into Bitcoin. So what does that tell you? That we're just getting started here. Actually, let's go ahead and switch to Bitcoin really quick. And I'm going to try to get through these pretty quick. So yeah, we did pump early. But keep in mind, we pumped early last time. And what happened here, June 2019? Here, I'll tell you what happened here. Let's see if this pops up. Come on, interest rates, where you at? Okay. Here's what happened in June of 2019. Okay, interest rates were falling. You would think that's positive, but the reason they fell is because growth started to fall over. I don't have it up here. Let me throw it on here so you can see exactly. I have it on. I have all kinds of charts on here. Let's look at man, this is okay. Here it is on here somewhere. I'm gonna copy it, move it over, and you'll be able to do this and think for yourself once. Here it is, supply chain management, copy chart. Let's go over. So you'll be able to do this after the course because I'm going to show you how to look this up, right? Let me move this up. This is basically, there we go. So this is why Bitcoin could not stay up, because this line represents supply chain, right? Supply chain demand. So Bitcoin ripped up early in the last cycle, and then you had growth just fall off a cliff. Where is the growth level at? Let's bring this down. 50 is basically above 50 is expansion, below 50 is contraction. So you had GDP demand or growth demand falling the entire time, right? Well, Bitcoin tried to make that move and then it went negative. So the ISM, this is the ISM manufacturing cycle. This is the manufacturing cycle, right? This is the business cycle. The business cycle went negative. So Bitcoin couldn't continue higher because negative business cycle means negative growth. Right now, we're not in negative growth. We're actually re-accelerating. And then when it did come up, we had, the pandemic. So I would say there's a lot of factors other than just that. We could even look at Fed funds. What were they doing? They were increasing rates until what? They cut rates right here. They cut rates because growth had decelerated tremendously. This was before the pandemic. The economy actually was decelerating. As much as people love the Trump economy, it was good, but we had he was begging for rate cuts. They started to cut rates. There was a whole lot of stuff going on at that point. But Bitcoin did try to make an early move. It could not. When it tried to recover, you got the pandemic, right? So yeah, we're in here early. We are, moving up, accelerating early, and nobody knows what's going to happen next. It might just continue to shoot up, but always expect the probability is we come back and retest the previous high, right? So at some point, we're going to come back to 69,000. Maybe we break below and but these flows are not just speculation. This is not leverage. These flows in Bitcoin are institutions. This is institutional adoption via BlackRock, via institutions, right? I said that like 5 times. Basically, they're not selling. They're not selling their Bitcoin. Hedge funds might sell. They're not going to sell. So you're not going to see a tremendous pullback. Now, I just talked about all the liquidity coming into the market. That's going to push Bitcoin and crypto even higher, right? So we are up early. Expect a pullback. Expect a correction, right? Pray for a correction if you're not in. If you're not in deep enough, you might want to pray for that correction. So that's how I'd answer that when it comes to Bitcoin. We are early in the cycle. And yes, I am coming up with the top. We're not going to go over the top today. We'll do that later on, where we predict the top of the cycle. It's going to come down to the credit cycle. It's going to come down to interest rate cycle. It's going to come down to the ISM business cycle. Once you see those all peak out and you get the RSI, bearish divergence, it's time to take profits unless you're holding forever, right? What up, Hassan? What happened to gold this week? Victoria Martinez. Gold. Oh yeah, what up, Hassan? How you doing? So gold this week, gold's going up because gold is predicting the Fed cuts rates and that they're increasing the credit cycle, right? This is why gold's going up, is simply because gold is predicting that the Fed is going to start printing money again, that the credit cycle is turning up. And they've already said that the Fed's balance sheet, which is where they inject and remove liquidity or credit into the system, remove credit, you know, once the RP runs out, and gold is just like Bitcoin. Bitcoin is gold on steroids. That's all it is. Gold on steroids. You can see they both, they both moved up. And once the Fed, the markets look 12 months ahead. So they're predicting that the Fed turns in June, right? They turn in June. Also, election cycle, they turn in June, and the Fed has to basically debase the currency, right? They're going to monetize all the debt that is out there. How do they monetize it? They basically create more dollars, and inflation doesn't go higher. It's not inflation that goes higher. That's from fiscal policy. It's asset prices that go higher. Asset prices inflate because they have to create more money and they inject it into capital markets. Gold and Bitcoin are sniffing that out. So they're moving higher because they move higher on liquidity. Basically it's basically like a trampoline, right? When you increase liquidity, it's like a trampoline for these assets. Same for BTC. Yep, 100%. On Bitcoin, all-time high before halving. Let me get back to so I don't confuse people. Let's get back to this chart. Asan, on Bitcoin, all-time high before halving. Does it mean parabolic? I think the halving is priced in. I think the halving is already priced in. Maybe we crawl up a little higher, but my guess is the halving is already starting to price in, and it's a non-event. When the halving actually happens, it's a non-event. And maybe Bitcoin goes to 80,000, then pulls back to 60. I think it's going to stay in the zone over the next couple months. I think it stays in the zone after the halving. That's when Bitcoin starts to gain momentum again. So my guess is by June, which is right around the rate cut. By the way, the rate cut is going to launch Bitcoin. It's going to launch crypto. So right around the rate cut, if that's the rate cut, if it gets pushed out, then you're going to have less momentum, right? You're going to have less momentum if it gets pushed out. But I think there's going to be a crypto summer. Crypto, June, July, August, it rips higher. That's the correlation, seasonality, right? Seasonal cycles. And then it starts to come down again when it comes August. Now, this might not happen. This is just historically what happens. Comes down to the end of the summer, consolidates, has a couple corrections, and then it bursts into the end of the year when, if Trump is elected, what does he say? Now he's positive on crypto. We'll see how things, point out. We'll see how things turn out. But there's a lot of liquidity. There's a lot of credit coming into the system. And the real threat here is, does inflation remain where it's at or fall? Right. So that's what we're always looking at. Cole McAfee. Oh, what up, Cole? Thanks for switching over here. I appreciate it. Past 20 years, overlay the Fed funds rate over the Dow Jones. Recessions has always followed, assuming people are holding their money until a bottom for better rates. I'm assuming Fed funds rate over the Dow Jones. Are you talking about rate cuts has always followed? That is not true. Rate cuts have not. If you're saying rate cuts have always followed, I mean, we talked about the early 90s, and I think that's what Cole's talking about. Thanks for the clarification. That's not actually always true. The reason that the market has fell during rate cuts or around rate cuts is because the economy rolled over. That's why it actually happened. It wasn't. And let's go ahead and look. SPX. Okay, let's throw on those rate cuts. I'll show you one example of where that didn't happen. Okay, let's throw on the Fed funds rate. Let's throw on the Fed funds rate. Okay, and that's a really good question. I'm glad you asked that. So here we go. Let's go to the early 90s because you said every single time, and I'm gonna show you why it happens. Okay, so this is basically Fed funds, right? This is the Fed's hiking cycle. You can see when the Fed was at peak rates, here's where they peaked out. The market started to go up because they knew the Fed was done hiking. Okay, this was also election cycle. So, rates were done going up and the market went higher, bro, right? So it's not every time. It's not every time. And I'll show you exactly why, because this indicator right here went negative. So they had to cut rates. And this actually should have been a little bearish. Let me make sure it's at the right. Here it is. So they started cutting rates and the market went higher. So that's not actually true. GDP, did GDP go negative in the 90s? I don't think GDP went negative. I don't want to take the time to pull out GDP yet, but this is momentum growth. Growth did fall, but the Fed hikes didn't didn't you can even there's a lot of ways to look at growth. You can use industrial production, which is real growth. I wish I had all these charts set up. I don't have them set up right now, but you can use industrial production, you can use retail sales, you can use the ISM new orders, right? And you can use GDP. So the market went higher even though the Fed was cutting rates, okay? And they cut down here, the market kept going higher. There was no recession, there's no stock market recession. Now there's some trouble in 96. We would have to do a further investigation to see what happened in 96, but that is not always the case, right? Now, obviously here, this was the dot-com bubble that bursted. Stocks went way too high. Growth was decelerating at that point. If we look at the ISM, and this is a measurement of how wide growth is. So it's measuring supply chains all across the sectors, right? From manufacturing to services, from healthcare, banking, industrials, tech, consumer goods. It's measuring all the sectors. Once it goes negative, it's telling you that there's a widening of growth, right? There's a widening slowdown of growth, and the market was way too high. It was, this was a bubble, and it broke, and the Fed had to cut rates. So that time it did happen. But there's another example here where the Fed cut rates and the market didn't necessarily fall. See if we can find it. I think no, '08 was a financial crisis. I mean, yeah, that was a black swan financial crisis, right? Not just because of rates, it was a financial crisis. Let's go to, I think this was actually, yeah, right here. We didn't have a lot of people try to use this also. So this was what? This was 2018. Growth was slowing a little bit, and you can see the Fed stopped hiking right here. Here's where the Fed stopped hiking. The market recovered, and this was also the tariff war, I believe. This was tariffs, right? So that was already putting pressure on growth. The Fed stopped hiking. The market recovered tremendously. I know I can zoom in a little more. The market recovered, and it started going higher. As soon as they cut, the market started going higher again, right? They're cutting, the market's going up. It went up how much percent? It's kept going up until the pandemic. You can't, you don't use a black swan to classify the market fell because of rate cuts. The Fed cut rates because the economy literally decelerated to nothing. That's why they cut rates. That's why the market sold off, not because of rate cuts. Rate cuts are the response of disinflation or a shock of growth, a downside shock in growth. That's why they cut rates. Either inflation comes down far enough and they can now cut rates, or there's a downside shock. This was a downside shock on this rate cut, but you can see obviously here there was no downside shock and the market was going higher on rate cuts because you lowered the cost of capital. You increased the, oh, there you go, Brian, thank you, Wall Clave. Okay, I'm going to put that up there, Wall Clave. Can't believe I forgot that one. So it's not always true that when they cut rates, it's bearish. It's just a false narrative. There's a couple of cases. Usually the market goes bearish when growth is falling apart first, but they don't really show you all that data. So look at the 90s. I know I went on ad nauseum on that, but I'm gonna make sure I answer your guys' question. I don't want to just give you a quick little, maybe you're waiting in line, but I don't want to make it too quick because I'm not doing streams every single day. So I honestly think we're about to hit a depression from a bubble that's been printed since 2000, but I hold a ton of crypto. So I'm hoping we at least have an alt season before then. True utility. Yeah, I think that's a false narrative that we're going to have this deep, dark depression. It's not going to happen. We should have had it in 2023 during the banking crisis, but the Fed stepped in. Okay, so I'm going to show you guys now. Thanks, Brian, for telling me. This is the Fed's balance sheet. This is why we're not going to have a deep, dark depression. It's not going to happen. Unless there's a black swan, like obviously if there's nukes and there's all kinds of chaos, but just on a normal business cycle, it's just not going to happen. So here's what happened, right? This was the banking crisis. You can see the market was actually rolling over. I remember this. I was like, all right, looks like we're going to roll over. Here's the bear market that we broke out of. We started to slip right here. And then what happened? The banking crisis hit. This should have been a 20% drop, right? Everybody was saying S&P down to 3,000, but the Fed stepped in and pumped $500 billion into the banking sector, right? To what? Secure all the deposits that were missing from the banks. And that was an injection of liquidity. That was net positive liquidity. We can look at it another way, which is we can turn on the Fed net liquidity. Again, I know these are confusing, but this is basically all the net activities of the Fed during that banking crisis that happened about right here. Here's the shoot up in liquidity. It came back down and it went right back up. And here we are with liquidity starting to climb. So credit is coming into the system. If it was disappearing, then yes, coal, we would be in trouble. But that's not the case. They're pumping credit into the system. They're not going to allow the equity market to fall apart because they need to serve the biggest, the biggest wealth holders in the system, which is the baby boomers. They hold most of the wealth when it comes to real estate, when it comes to equity. Those are baby boomers. They're just not going to allow it to happen. So if we get a black swan, yeah, there will be something terrible. But if a black swan hits, what are they going to do? Their inflation falls apart. They're going to pump interest rates just like COVID. They're going to drop rates. They're going to pump credit into the system. Asset prices go higher. That is the name of the game. That is the name of the game right there, buddy. More than 70% of Bitcoin has not moved out of their wallet since 2013. Very bullish. Only 20% has been traded over time. Yep. PPI tomorrow. Thoughts on PPI? I don't really know at this point. I really don't know. I think it's going to come in. I really don't know, Jervine. At this point, it's really hard to tell where producer prices are gonna come in. I would just say, look, when I look at commodities, so when I look over on the macro commodity side, let's go to the commodities really quick. Let's switch this up. And I know this is a lot of information. If you guys are interested, I'm still building the course, right? So you can think for yourself. So you can take this data for yourself. So you can see the cycles of, commodity cycle, the dollar cycle. That's a big one. We want the dollar lower to go higher. To look at the interest rate cycle, the credit cycle. So you're not fooled by, financial media and all these people just saying there's going to be a giant recession. Everything's going to crash because, dude, these dudes don't know what they're talking about. These dudes are just getting clicks and likes because it pays for fear, right? When you put fear in people's mind, it pays. Now, hey, if there's a black swan, sure, things fall apart. But you're going to bet on a black swan? Good luck. Good luck. If you see it, if a black swan does come, I guarantee you the US dollar is going to start spiking. That is the history. The dollar spikes first. Bonds start to go higher because they're pricing in. If smart people know there's going to be a drop, if the people at the top know there's going to be a drop, they're not going to tell you. They're going to start making a move, just like during COVID. So here, if you want to predict a black swan, you're not going to be able to predict it, but you can at least see it coming. Let's go back to COVID. Let me kind of show you what I'm talking about here, right? Here was the last black swan event. Okay, this is the bond market, right? Here's the black swan event. Here was the pandemic. Check out how you saw before the pandemic hit, bonds started to slip. The bond rate started to slip. So in reverse, this is actually TLT. So let's inverse this so you can see what I'm saying here. I'm going to inverse this so you kind of know. Let's do invert scale. Okay, so bonds are protection against a recession. That's what they do. Right here, the bond market started to bid up in January of 2020. Right? So the bond market was already saying, hey, something's coming. And it didn't go slowly, it exploded. And then it exploded again. So the market will tell you if a black swan event is coming. You'll see it in the bond market or the US dollar, right? The US dollar did the same thing, DXY, started to spike during the pandemic, right? The dollar went up and bonds went up. Why? Because they're safe havens against, and the pandemic is right here. Here's where the stock market slipped. But the dollar and bonds moved first because the smart people knew, hey, this is a big risk, which is why we always look at the bond market, which is why we always look at the dollar to see, hey, is there something changing in the price action? Are the smart guys, are the institutions seeing something we're not seeing? And if not, then we keep moving forward. But if all of a sudden bonds start to spike, you're going to see interest rates drop fast, right? It's always a sharp move. It's not that they're moving higher. It's that they sharply move higher, right? It is the speed at which they move that tells you something's wrong. So that was the last pandemic. Other than that, we're not seeing that right now. Bonds are actually falling at the moment, right? So invert scale back, that is yields, right? Interest rates started to drop. This is long rates. They drop fast because they're pricing in, hey, something is wrong with growth. Okay, let me take this off so we don't get too confused here. Can you give a synopsis of Basel 3? Sly dog. You know what? I don't really have a full synopsis on Basel 3. I think it's a bunch of crap, bro. Basel 3 is a bunch of documentation, blah, blah, blah. The key here is Basel 3 is basically a front. It's just a front, right? To get more liquidity. That's all it is. All the authorities, the fiscal authorities, the monetary authorities, they do not want the market to crash. Stop believing I don't want to tell you what to do, but you got to question these doom and gloomers who are telling you everything's going to, they want the market to crash. look, Joe Biden does not want the market to crash. The Fed does not want the market to crash because they'll lose their votes. They will lose. They want the market to go up. So the bigger risk is inflation, right? It's not a crash. The bigger risk is that inflation comes back and they have to increase rates again, but it's not happening either. That is not the case right now. So Basel 3 is, just keep in mind, Basel 3 is telling us that they're pushing for the banks to be able to buy unlimited amount of US treasuries, which literally, quite literally, if bonds go higher, if US treasuries go up, the rates come down, right? Long rates come down, and that actually increases liquidity for the market. And that's what we're staring at, is Basel 3 is saying this market is going higher. Basel 3 is saying bonds are going higher and interest rates are coming down. More liquidity, more credit into the system. That's Basel 3 right now. Ignore all the other crap. It's all a show. It's all a show for the most part. All right. Yeah, I don't know about PPI, Jervine. I'm not sure. You've been right about this melt up for hey, appreciate it. I'm glad somebody notices. I'm right about the melt up. Hopefully, hopefully we can benefit from it. And you know what I've been saying this whole time, the best opportunity will be crypto. In this cycle, crypto will move faster than everything else. Even Nvidia's obviously been moving up a lot because it was one of the themes, right? Chips, AI, right? And it was a smaller market cap. But I'm telling you right now, and Nvidia might keep going up. I was wrong about Nvidia. I didn't think it was going to go up that much. I was wrong about Nvidia. But Bitcoin and crypto are going to go up much more than everything else ex Nvidia at this point. I'm not sure what Nvidia does, but you see Bitcoin's up 100% over the last 2 months, 1 month, and it's just getting started. Inflows, real institutional inflows are coming. It's already at 1.4 trillion as a market cap. I'm bullish on Chainlink, and we'll talk about that later to end the show. Save the best for last. I think Chainlink is the biggest opportunity I've ever seen, right? And I'll tell you why. But let's keep going here. Okay, something is wrong in the system when they start cutting. No, that's not true. Cole Metcalf. It's not that something is wrong when they start cutting. They're cutting from high rates, right? So interest rates are already high. I'll say this: you're half right. You're half right, Cole. They do start cutting when I'm going to throw on the Fed funds right here. They do start cutting when something's wrong or when something's right. So if rates are already elevated and they're elevated because inflation is up, so let's go ahead and throw on inflation. And I have all these charts in, so you can see this inside the course. I'm building it right now. So you can see the history all the way back to 1950s, how the interest rates and inflation actually work. Not what people point out on Twitter or on social media, but how they actually work, the real history with charts explaining what happened, right? So stay tuned. I'll have that out. All right, let's go. Let's bring this down. Okay. So basically, inflation was too high. That's why they hiked rates. Something was wrong. They hiked because something was wrong. So we can't be one-sided and say they hike when something's wrong and they cut when something's wrong. No, not necessarily. It's the level of rates. Rates went up because inflation was up. Inflation came down to a significant level, so they stopped hiking, right? Now, if growth does fall apart, right? If we do get a growth shock cold to the downside, then yes, they would be cutting because something is wrong. But if inflation just comes down and growth doesn't, they're cutting because inflation is down to avoid the growth shock. For instance, if they continue to hold rates at this level, eventually it will stress out. It'll stress the market. It'll stress the economy enough to where we do get a downside growth shock or we start to slow in growth, right? So what they're trying to do is coordinate, well, we need inflation at a certain level where we can start cutting a little bit to prevent growth from shocking to the downside. But just because growth slows isn't a shock. You need a shock, right? We're not seeing a shock right now. You got way too much fiscal policy. I mean, trillions of dollars coming from the government. We're not going to get a growth shock to the downside without a black swan. I'll say that, right? So what they cut, they're going to cut because inflation came down far enough, or they might cut because a bank fails. But the too big to fail banks are not going to fail. It's going to be a small bank, and that's going to be an excuse to pump more liquidity. So we'll see what happens there. But yeah, I get your concerns. I mean, it's out there. Something bad could happen, but it's just not where the evidence is right now. That's just not where the evidence is pointing. I think a lot of it is wishful thinking in my view. What are your thoughts on Tesla? Tesla looks ugly, but I'll tell you what, for the long term, I still believe personally, and smack me if you want, Tesla's the best opportunity as far as a stock. I like Palantir and Tesla. I'm not wavering off that. As a trade, Tesla has not performed, but but as a long-term hold, right? Energy storage, full self-driving. If you're looking forward to technology, because the future is always technology, I think Tesla's the best opportunity. I think it is the best stock in the market. I think it's going to be bigger than Apple in 5 years. Who knows? There's a lot of evidence behind that, but it's really, you're betting on technology. Basically, you're betting on the robots, right? The robots brings more labor force. There's a labor shortage right now, which is part of the reason immigration is helping, to some degree, or illegal immigrant, whatever you want to call it, is helping, because you're getting more labor force, because the baby boomers are retiring at a record pace. So you need more workers. You see a lot of Americans don't want to work, so immigration, whether it's legal or not, it is coming in, and it's cheaper labor. So what happens when you turn robots on from Tesla? Maybe it comes in 3 years. When you turn on robots that can do labor, you increase GDP production. So the robots is one, full self-driving is another one, right? And you also have the big one, which is energy storage. Once you get to the level where you can store the sun's energy in a battery, it's over. It's game over for Tesla. You're looking at the biggest components to the economy, which is labor, energy costs, right? And transportation. That's why I think Tesla's the best by far into the future. Not today, but into the future. Because if they execute, right, they have to execute. If they execute, it is game over from Tesla. But they still got to execute, right? There's risk there, of course. Um, Chart looks like crap. I know. Look on TikTok. If I can't see all your comments, I'm gonna look when I'm done talking. I'm going over the YouTube comments, but if you want me to see your comment, jump over to YouTube, comment in the YouTube stream. Link is in the description. Okay, what do you got here? Look at historic charts and see historically there's accumulation phase after halving. Yeah, 100%. There's a accumulation phase right after the halving, and then you move higher. And I think we get a bump higher in the summer, we slow down, and then end of the year we rally again. Could be wrong. Maybe that's 50% chance. Maybe we just go vertical all year and then we peak out early. Who knows? There's probabilities that we're looking at, and we just got to weigh the probabilities and keep up with the data and the price action and the macro risks. Are they falling? Are they increasing? To see what might Bitcoin do. But for the most part, keep your eye on this. Bitcoin moves faster, Bitcoin moves off liquidity. And so far, everything's pointing to an increase of liquidity going forward. So that's why I'm very bullish on Bitcoin, because liquidity is net going up, right? And here's the big one. Watch, Wall Clave. This is the Fed's liquidity. They are draining liquidity from the market. This is the credit card, right? Your credit line's going up. Oh, inflation's too high. Let's reduce the amount of credit, and the reverse repo ends, sometime in June. Possibly it runs out. They've already said in the Fed minutes, they've said this live, that they're now talking about reducing the sell-off pressure. They're reducing $90 billion a month of treasuries, or instance, they're pulling out $90 billion of cash from the system every month. So they're going to slow that down in June. And then eventually this Fed balance sheet is going to go up, and they're going to be injecting $90 billion. I don't know what it'll be exactly, but they're going to be net injecting liquidity back into the market. When they start injecting it, asset prices are going to boom. That doesn't mean inflation necessarily. It could be, but what it does is it gives liquidity to the banks, and they're going to take risks somewhere, right? Especially if they cut rates and cash no longer yields what it's doing. Fed funds is the rate of return for cash. That's what Fed funds is. So if they cut rates, banks are going to start moving their cash into assets, right? And the credit comes in, it's going much higher. You have to contain inflation though. And right now, if productivity keeps picking up, if we produce more than we buy, more than we demand, inflation does not go higher, right? So I think inflation is still net negative. A lot of people don't agree, but I think by the second half of the year, inflation is going to be down to 2%. I think we're headed there pretty quickly, especially if we get a growth shock, a small one. Taking the time, honestly, yeah, for sure. Look, I'm open to changing my mind. I just don't see the evidence for some deep, dark recession, depression. I don't see it, right? Everybody points out 2 or 3 variables when the other 6, 7 variables are pointing the opposite. They don't talk about the reverse repo facility liquidity. They don't talk about the Fed stepping in, right? They're not talking about the things that are actually net positive. They just want to talk about the negative. If there's an accident and 10 people see it, you take the perspective of the 10 people, not of 2 people. So there's a wide, there's a bunch of data. You got to see all the perspectives, not just one. And when I look at all the perspectives, there is no deep, dark depression coming. If anything, Inflation is sticky. That is probably the biggest outcome. Inflation sticks around 3% for the most part, right? So should I sell everything and put into Doge and Pepe? We got a troll. I mean, not a troll, but Bukowski. Yep, I get what you're saying there, bro. Just going Doge and Pepe coin. Yeah, he's just being funny there. They could beat inflation. The last big number has fallen off year over year unless deflation happens. The Fed has, well, we're getting disinflation right now. So let me make sure I read this. I'm reading this correctly. You can go ahead and put your comments in if you're wondering. They could beat inflation. The last big number has fallen off year over year unless deflation happens. The Fed has been checkmated. Okay. Not 100% sure what you're saying. I think as long as we're in disinflation, we're good. Deflation would be prices start to reverse. That's even worse because if we get deflation and then that means they're going to just pump more liquidity. They're going to cut rates and pump liquidity. So you might get a shock in the market and then boom, here they go again to the rescue. It's very simple. I posted it. It's hard to see all these numbers though because you got to put the charts up, but I'll be posting more charts. They're going to pump more liquidity if that happens. Most people on TV screaming fear. Yet you know what? Yep, have a skin in the game. Yeah, listen, Peter Schiff. It's almost like they want to crash because they own gold. If you notice, there's a trend. People who want you to buy gold are almost cheering for a collapse because that means their gold goes higher, right? But if there's a real collapse, it doesn't matter. Their gold doesn't go up. They're just hoping for QE. Really, that's all they're hoping for. They're talking their bags. My bags are crypto. I'm going to keep it real, but I'm not a fool. I know what drives crypto up and I know what drives it down. You want to know the argument? If Fed liquidity started to go down and if they kept interest rates where they're at, crypto's going to struggle a little bit. Even though there's net inflows, it's not going to be as strong of a rally. Period, right? If the crypto blockchain somehow got banned in the US, which is nowhere to be seen, then if Bitcoin got banned, which is now it's not, I mean, it's literally commodity, then we'd be in trouble. So you got to know why and when to shift the narrative. But a lot of people don't know when to shift. They're just buying into this crap, which is why I'm here to tell you to think for yourself. Go do your research on what I'm saying. Think for yourself. Don't believe what everybody's saying because they have 1,000 followers or 10,000. A lot of these people don't know what they're talking about. They're just repeating stuff to get likes. I'm going to sit here and tell you and answer your questions on what I see. Do I know everything? No, but I'll go find out, what the answer is. I'll go find out what the best probability is going forward. What do you think of metals and all-time highs? Then they say they haven't bull run together. Metals all-time high. Yeah, metals are turning up a little bit. I mean, silver and gold, but crypto's a superior store of value. So Bitcoin or metals are going up because they're anticipating the credit cycle turning up, right? And if the credit cycle turns up, that means commodities start to boom. China's economy starts to grow again, and metals go higher. But crypto or Bitcoin and Ethereum are metals on steroids. So why would I get the less superior asset, gold? It's less superior in my view. I'm not going to get gold. I want crypto. And what is the future? Ask yourself, what is the future? Is the future digital or is it gold? It's digital. The future is digital. Little kids they're trading money digitally. That is the future. Cash will not even be a thing in 10 years, 5 years maybe. And it's going to be digital, right? So, I mean, you just got to, think for yourself, but the future is digital. It is not hard gold. Gold will still be a store of value, but it basically protects your wealth. It does not grow your wealth the way that Bitcoin does over time. If you buy the lows, if you're buying the tops, I mean, you're going to struggle. I've heard people say Bitcoin will go all the way up to 100K. Some say we'll go to 80K. What are your thoughts? I think Bitcoin goes to 150K at minimum for this cycle if things stay in line the way they are. If things stay the way they are, if the macro continues to improve, Bitcoin goes to 150. I'm not going to say it's this year or next year. It could be 100 this year. It could be 150 next year. It could go as high as 250 next year. I don't know, but I know it's going much higher than it is today. In 12 months, Bitcoin will be much higher than it is today. That's my prediction. Not financial advice. 25% of my crypto oh shoot, hold on. Let me make sure I don't get kicked off. Let me jump over a little bit to the TikTok. I know I missed a lot of the TikToks. I see you guys right there. How long will this bull market last? How long will it last? Okay, TikTok. Hey, TikTok, have you been waiting? Just throw your questions in or your comments. How long will the bull market last? I mean, if we could predict that, we'd all be millionaires, trillionaires. billionaires, but we can't predict it. What we can say is, how long should it last? I think, the cycle of credit, I don't know, maybe 2025, 2026. And then you have a correction. For now, what I'm seeing for now is over the next 12 months, we're going to be higher. I think S&P is going to do better than people expect because they're still bearish, they're still negative, right? So I think we're high, and plus it's a stock pickers market, right? It's an asset pickers market. You just got to pick the right asset. How do you do that? Well, you have to educate yourself, and you have to test what you think you know against what other people say, right? So I can't tell you what to do. I can only tell you what I'm subscribed to the newsletter. You'll see what I'm interested in. You'll see what I'm betting on in the newsletter, and we'll talk about Chainlink in a minute. Do you have any crypto coins you're bullish on? Small cap. Bukowski, the smallest cap I'm bullish on were GRT that exploded, the Graph, and Aave. I'm actually really bullish on Aave right now. I'm still, very long in Chainlink, but if Aave starts to look at this, look at Aave, man. Aave is moving. Um, let's go to Aave really quick. I like Aave. It's decentralized. It's basically lending and borrowing. It's a lending borrowing protocol from Ethereum, off Ethereum. Uh, and the price action is very bullish. Let me take some of this stuff off. Very bullish price action. Finally starting to move. Still, it's like $1 billion or $2 billion. It's still pretty small, but I am not going for these small coins. Like, I don't do that stuff. I just don't do that. So when I look at the technicals for Aave, they look really good. All right, I'm going to take all this off. We don't need it. So that the chart can open up a little bit. I'll keep that there. So I like Aave. It is ripping higher. I'm hoping for a pullback right into the trend. That would be magnificent. But I don't know. We'll see. I'm not going to go chasing things though. I'm not going to go chasing it. My brother pointed this out about 2 weeks ago, and I said, "Dang, Aave looks really good." Right after it broke this trend and started to trend up. So I like Aave. I'll stick to the things I think can actually win and make new highs, not necessarily just because they're small. But that's my take. Aave. I used to like synthetics, not anymore. Aave and crypto is already a very risky asset class, so I'm not going to take a lot of risk there, right? I like to focus a lot of energy into something that makes sense to me. Avoid all crap cryptos, XRP. Yeah, that'd be good to avoid them. They might go up, but they might crash also. Crypto goes with stocks and tech, not metals. Well, I mean, it's not really that the crypto goes with stocks or metals. Different stocks are like the Nasdaq. Tech actually moves different than the Dow, right? So it depends on the type of asset. It depends on the profile of the asset, Cole. It's not that crypto, it's just that metals like gold and silver typically move higher when the hiking cycle is done and when the credit cycle starts to pick up. And it just so happens that so does a crypto, and so do stocks, right? So they all sort of move on the monetary cycle, but they're Bitcoin's a commodity. It's more of a commodity. So it depends how you look at it. I'm not saying you're wrong, but you know, crypto will decorrelate from stocks at times. It's more correlated with stocks on the downside, but when stocks are moving up, crypto decorrelates from stocks. That's typically how it goes. What do you think about real world asset coins? Yay or nay? I've been trying to find some good ones to invest in. I thought idea of real estate and crypto was interesting. The only real world asset slash interoperability coin I'm into is Chainlink. That's about it. Chainlink, and I'll tell you why. Chainlink is I'm not even going to talk about it right now. I'm going to go over that afterwards. But the only thing I'm betting on is Chainlink right now, outside of Bitcoin and Ethereum. Jeremy, what's been your all-time best call trade, worst one? Best all-time, I mean, Tesla back in 2019, caught that big one. And then I would say Ethereum and Bitcoin in the last cycle. Those were the best trades I've made. The worst trade I've made was Palantir. I levered into Palantir at the top of the cycle. And this is why I am so obsessed with macro, because I realize no matter how good the company is, no matter how good the technicals are, if the macro is not right, I'm going to mess up. So I lost 100K on Palantir. All right. That was my biggest loss, but I've made more than that in, Tesla and crypto. So that's my big loss, right? I got scars. Thoughts on the graph? I like the graph. I don't know about render, so I'm not 100% sure. Let me jump back to TikTok over here. Do you believe XRP can be the next Bitcoin? Heck no. H to the no. XRP to me, I'm just going to say it, trash. Price predictions for Chainlink, somewhere between 100, 150, possibly 250. It's going to go over all-time highs for sure, in my view. Not financial advice, but it's really hard to call prices if the macro continues, if the narrative for Chainlink, which is the biggest narrative, I think, in crypto outside of Bitcoin and Ethereum, right? And I know, some people might say, oh, what about Cardano and AVAX and all that? Well, basically, Chainlink it solves the Oracle issue. What people need to understand is that blockchains cannot connect to each other. They do not connect naturally. They can't connect. So they need a connector, right? They need an oracle which connects them. That is Chainlink. Chainlink is by far the most dominant oracle network, not even close. And it's not just connecting blockchain technology either, blockchains to each other. It's connecting the private blockchains, which are the blockchains for, like, let's put it, let's just dive into it when it comes to Chainlink. I'm going to say this, I'm going to go over this really quick. Do your own research. I have a couple blogs on Chainlink. You can go to the website, check out the blog on Chainlink. I would just look at Chainlink's YouTube channel, just study Chainlink, right? But basically, it solves the Oracle problem. Blockchains can't connect to each other. Okay. And the largest banking network in the world, okay, the largest banking network in the entire world is the Swift messaging system, and they're partnering with Chainlink, right? The largest settlement network in the world is DTCC, the Depository Trust Clearing Corporation, is the biggest clearing settlement layer, network in the entire world. And they're partnering, or they're using CCIP. They're connecting to Chainlink so that they can tokenize all of the money. They can tokenize all their assets, whether it's treasuries, commodities, real estate. They're tokenizing it, and they need it to move from one chain to another. This is not crypto blockchains. These are private blockchains, right? These are between the big institutions. They're connecting to CCIP, which is Chainlink's technology, so that they can switch. Now, the big picture here is that in order for that to work, you need to own the Chainlink token. You need to buy and sell it in order for these services to work. So the biggest institutions on the planet, even Euroclear, which is the clearing corporation for Europe, European central banks, Australian central bank, the biggest banks are connecting through CCIP. It just takes a while for them to bring this online. It always takes a while. So I just see a much bigger total addressable market when it comes to Chainlink than all those other coins outside of Bitcoin and Ethereum. So yeah, the tokenization, the whole tokenization thing doesn't work without Chainlink, right? Decentralized finance doesn't work without Chainlink. They need a connector, and it has by far the most secure, efficient system, not even close. I like Aave. Yeah, I do like Aave. Small mid caps want something to explode upside. Good projects, small and mid caps. Okay. Even though the U.S. is slightly less dependent on China, Apple sales in China dropped 24%. Well, China is having an issue right now. It won't last forever, but China has a real estate issue because basically nobody's buying their debt, right? Their population is falling. They don't have a lot of productivity. They keep injecting liquidity. It's not working. So China needs some investment. I think there's going to be a deal done with China at some point. But once it comes back, yeah, iPhone sales will go up. Most China, like in the US economy, our economy is driven by consumer spending, but China, it is not. It's driven by real estate. So the real estate sector is just trash right now, and there's no liquidity. So we'll see. When China comes back online, they'll be fine. Maybe it doesn't. I don't know. That's why I'm more bullish on Tesla. Are Quant Link competitors, or do they complement each other? Quant and Link. I think Quant. You got to ask somebody more technical. I'm not sure. I just know Chainlink by far, okay, and go test it anywhere, is the best protocol when it comes to that. I don't think anybody's even competing with Chainlink. They try to, but it's not even close. It's like Motorola. It's not competing with iPhone. Okay, nobody's competing with Tesla. BYD is close to it, but BYD is not a superior technology than Tesla's. It's just in China, they have they have a bigger market, and they innovate a lot faster. They're a lot more liberal in how they change things, like how they evolve. So it's a bigger market, but Teslas are still the superior asset when it comes to EVs. Here in the US, the technology is better, the range is better. They have more data. So I don't think they're competing with Chainlink. They might be trying to. I don't actually know, so I'm not going to answer that. XRP is dead. I agree. During a bull run, everything moves higher, but value coins like Link will be more juicy. Yeah, and that's what I'm saying is a lot of things will go up, but when the rug gets pulled, when the water recedes, who's going to be left, right? You're going to see who's really has no real project, who doesn't have a solid project behind him. I know Chainlink has a solid project, so I'm not going to go chasing those coins and accrue more taxes on trades. I'm not going to do that. It's a waste of time for me. But hey, if you do it and you make money, good luck. Thoughts on Nvidia? Nvidia is a monster. Big pullback in Nvidia. It'll do fine. What are we at? 115. All right, I'm gonna try to jump through these TikToks. Thoughts on stacks? Not sure what that is. Low MC Gem. Blah blah blah. Took it at Dex Tools. No clue what you're talking about. Thoughts on Gala? Not interested. I don't really know. Quant is better than Chainlink. Not even close. What about Dogecoin? Trash. Don't mess with Dogecoin. Dogecoin might shoot up again, but it is a meme coin. You got to decipher the difference between a project with a base with fundamentals, right? It actually has a problem to be solved. Dogecoin is not solving anything. Shiba coin is not solving anything. They're meme trades, right? They're popular trades that get popular, like Pepe coin. So if you catch it, if you catch it from the lows, if it goes up, then you're going to make a lot of money, possibly. But some people hold it too long because they think it's an investment. It's not an investment. It's a trade, just like GameStop and AMC. When they exploded, that was a purely trade. That was a orchestrated trade, but they have no real value, right? AMC is trash. The theater is great, whatever, but the actual business doesn't make much money. It's failing. GameStop, same thing, right? So you got to decipher the difference between a trade, a meme coin, or a meme trade, a meme asset versus a real fundamental asset. A real fundamental asset is going to, you want to hold that for a while. A meme trade is a trade. It is just that. And you don't buy it at the top when it's popular. You have to know some kind of, you have to watch the technicals and maybe, track Google Trends. I mean, there's all kinds of stuff you could do to trade it. I'm not interested in all that though. Do you truly believe XRP can be the next Bitcoin? Not heck no, I've never said that. Not even close. XRP is nothing like Bitcoin. Can you look at Hood? Okay, let's see. We'll do a couple charts. Tesla's going to 2 digits. I'll buy more. What's up? I don't know who that is. Oh, what up, Jet? Unforeseen event that brings the market down. Thoughts on Lockheed Martin? I don't really care about Lockheed Martin. You got to be an insider for that. A black swan is an event that comes out of, like, the pandemic was a black swan event. The 2008 financial crisis was a black swan event. Inflation wasn't really black swan event where the market sold off because we could see it through the data. A black swan event is when there's a shock to the market, right? Like oil spikes, oil spikes. That's going to be a shock. It's not really black swan because you can see the prices. You couldn't see the pandemic coming. That was a black swan. So black swans, by definition, are unforeseen negative events, negative shocks that are unforeseen. So when people try to guess them, they're guessing like they were right at, the people who were right in 08 are still calling for black swan events because, their ego, whatever it is, but they were wrong. Every year they're wrong. And then they're right one time. They're like, yeah. So yeah, you don't want to guess black swan events. What you do is you have to find somebody you trust to be able to know, like, hey, is this a real negative event when it starts? Or is it just something that'll pass? And I've been wrong. I thought I didn't know the pandemic would be that powerful as an event, right? I didn't realize that GDP and growth would collapse to zero. I thought it was fake, and I was wrong. The whole economy shut down, but the Fed stepped in, right? So you want to say, okay, how long until the Fed steps in? It's really complicated. It's not that easy, but black swan events typically come every maybe 5-10 years. They're not something that just comes automatically, right? You could get a black swan event, but by definition, you can't predict that. What else we got on here? Yeah, Doge, nah. What does it mean when bonds, stocks go up together? That's a good question. When bonds and stocks go up together, it just means that, well, in this case, it means inflation's coming down because bonds are a safe haven to falling. So bonds go up when growth is decelerating because that means you're going to get paid fixed income when you hold a bond. You get fixed income on a bond, right? So I'll put up TLT. TLT is basically, and I'm actually, this is going to be in the course, and I'll break it down to simple terms. TLT is fixed income. So whenever you get a growth shock, so growth falls apart, what happens is interest rates, they move opposite. Interest rates go up and bonds go down because they're literally correlated. So you can literally see every time that interest rates went up, bonds came down. Interest rates come down, bonds go up because they move in opposite direction because they're literally tied together. Same, two heads of the same coin. And the reason this happens is if there's a growth, so let's go to 2018. Let's try to make this let's go to 2008, right? We always go to '08. So '08 was a big scare in the market, a growth shock. '08 was a growth shock. Let me try to make it a little bigger. So what you got was, okay, the economy's falling apart. You can see bonds start to bid up because growth is falling apart. And if there's no growth, there's no appreciation in businesses. They fall apart. You're going to get an unemployment spike, and bonds went higher because you're getting fixed income from the government, and it's a safe haven. It's not a store of value, but it's a promise that you're going to get paid even if businesses fall apart. And they're tied together, so interest rates come down together. They're literally tied together. Just keep that in mind. And then when the actual crisis hit, bonds spiked because there was no growth. Everything fell apart, bonds went higher, and then the Fed stepped in. They pumped a bunch of liquidity, and that means risk on. So, the Fed is saying, all right, we're going to go ahead and purchase a bunch of bonds and or not purchase a bunch of bonds. We're going to go ahead and inject liquidity so people leave bonds and rates go back up. So, whenever bonds and stocks go up, I probably made this way too difficult to explain. I'm not in my simple brain. I'm in my complex brain. Sorry. But in '08, this didn't work. I mean, during the pandemic, it didn't work. Bonds sold off tremendously. These are bonds. They sold off for one reason, because inflation, bonds cannot go up when inflation's up. Because if the rate of inflation is 9% or 8% and bonds are paying you 5%, then you're losing money on your bond, right? The rate of prices are higher than what the interest pays you. So bonds are no good. They're trash. The only thing that actually worked when there was inflation was oil, the inflation, which is oil or maybe some type of consumer goods that went up. I think Amazon went up a lot. So Amazon did sell off. Don't get me wrong. That's because the Fed was hiking rates to get rid of inflation. But when bonds and stocks go up together, basically interest rates are coming down, which means it's cheaper for stocks to move higher because it's cheaper to borrow, it's cheaper to grow, and if it's cheaper to grow, you're going to move up, right? So bonds are moving up together. Now, at some point, bonds will stop moving up. And these are interest rates. Bonds will stop moving up at some point. I don't know when that point is because it'll be more. This is a very hard complex topic to explain, but it'll be more profitable to own stocks than to own bonds because new bond buyers are not going to get the same rate of interest, which is the interest rate. They're not going to get the same rate of interest as they did. So, man, this is hard. I can't explain. If you're a newbie, you just got to get the course because right now, my mind is not simplified. I have to change my mindset to explain this in simple terms. And that means I have to woosah and reset. And I just can't do that right now. I'm kind of amped up. So I'm sorry about that. But just, I have a couple of videos on bonds and stocks, but simply bonds going up means interest rates come down and stocks like lower rates. At this point, they like these lower rates. So they're going up together. Where do you think ICP will go? ICP might be a scam. It probably goes up a lot, but I don't really like it. Most cryptos fail. Just remember that most cryptos are trash, which is why Bitcoin and Ethereum have outlasted everybody else. There's some other projects that are really good also, but there's just so many projects out there. I think the market is going to have a big retracement before it shoots through all-time highs. Too many people right now. Possibly. Credit hit all-time high today. You're probably talking about credit debt. And the thing about credit is also a reflection of spending, right? This is why the Fed probably cuts rates because credit debt is so high. And to prevent a growth shock to the downside, they're going to cut rates, and that eases financial markets. So we'll see if it happens in June. There's a lot of commercial real estate refis that have to happen. It's all liquidity flows. Yep. Reverse repo, only thing propping up the market. One of the things, I mean, you guys got to keep in mind, earnings are really good too. Earnings have been tremendously good because of AI, because you're cost cutting, you're basically, you get less for more with AI and productivity. And so earnings are good also. It's earnings, financial conditions, and liquidity. Liquidity is moving up, earnings are doing better, interest rates interest rates are still kind of high, but they're coming down. So all the conditions, and then you need inflation down, but all the conditions for a very strong bull market are starting to align. Your biggest risk is that oil spikes higher, because oil will bring up the cost of energy, and that's going to bring a growth shock to the economy. And if that's the case, then you're going to get a correction in the market, right? But it's an easy fix. If oil spikes, the Fed, actually, that's not an easy fix. That's the bad fix. If oil spikes, that's the biggest risk in my head. In my head, the biggest risk is that oil spikes. But I think the US is going to do a deal with Saudi Arabia where they flood the oil market the way that they did this in 2000. I've been doing my history here, so pay attention. Let's go to SPX. Okay. They flooded the oil market back in 2015. Is this 2015? No, this is 20. What am I doing? Let's go to 2015. History doesn't repeat, but it does rhyme. So 2015, okay, look at oil prices. They collapsed because this was when shale came out, right? The shale boom. Basically, you can increase the supply of oil for cheaper, and OPEC saw that, and OPEC said, "Oh shoot, okay, so now oil prices are not oil prices now. If oil prices are high, where was oil prices at this time? Oil prices are about $100 a barrel. That was expensive. So US came out with shale, which is, what is it called? Fracking, right? And fracking meant that if oil prices are high, well, we'll just get it from fracking. We'll just get our oil from fracking. That meant demand for OPEC dropped. So OPEC said, all right, in order to get the only way that fracking works is if oil stays high, right? Because if prices are too high, like it's like gasoline. If gas is too high, well, you're going to go to electric vehicle if it's cheaper. Maybe not today, but that's kind of the future. And so OPEC, what they did is they increased production tremendously. They just produced a bunch of oil, collapsed the oil market along with traders selling the oil market in order to get their demand back. Because if oil goes down, if your gas goes down, you're like, oh, maybe not electric vehicle. Maybe I'll just stick with my gas car because now oil, gasoline prices are lower. So when you get, what was my point of even going over this? Um, I don't even remember why I said this. See, I'm getting lost now. But the whole point is lower energy costs are always positive for the market. Now, it didn't happen here because you had growth, sluggish growth here. Economic growth was sluggish at this point, and the dollar spiked. That's why this happened. The dollar spiked because oil's priced in dollars. So if you sell off oil, all the investors in oil, they're going to sell into US dollars. The dollar spiked. And when the dollar spikes, equity markets struggle, right? They struggle. This will be inside of the course, but every time the dollar spikes, equities or stocks or risk assets very much struggle because now the dollar is more valuable and people are going into cash for who knows what reason. It could be interest rates, it could be a risk to the market. And this was a downside oil shock. Sorry, it's been an hour and 30 minutes. Um, my brain is still working, but I'm jumping around topics a lot. A shale boom cost me my job back. Oh, shoot. See, he experienced it. A shale boom cost me my job back in 2015. Massive layoffs due to oil price collapse. See, that's what it was then. Okay, thank you. You reassured it for me, Bukowski. The shale boom collapsed the oil market. Therefore, all the oil companies had to lay off a lot of people because they no longer had the profits, right? Their businesses failed or the businesses fell. So people got laid off and the economy slowed and the stock market was very sluggish and the dollar went higher. So people went into the dollar. So all these things, all these macro forces, they're like a puzzle. It's like a puzzle. The more you can see how the trends work, the more you can see the picture. Then you can make a more accurate, an accurate, I don't want to say prediction. You can make a more probabilistic, I guess it is prediction of the outcome, right? You don't know, you never know. It's like a puzzle, but the more puzzle pieces you get, the more you see how they connect, the clearer the picture is. And if you know where you're at, then you can see where things are headed. If you can't, then you just believe every headline you see, right? And that's what my campaign is to get people to see how the macro market cycle works to increase your market IQ so you can make choices for yourself. So you can think for yourself. You can see all the puzzle pieces as they come in, because the information does change quickly, you can see all the puzzle pieces, put it together, and get a clear picture for yourself. And then you don't have to just believe somebody and be so, not be able to sleep at night. You can say, okay, when the dollar rises, something bad is happening, right? Something is happening, and that's not good for equities. That's not good for crypto. If the dollar is selling off, usually that's connected to more money supply and lower rates. Therefore, asset prices go higher. So there's a puzzle. It's all a puzzle piece. I'm almost done here, so throw in your questions. What's the opposite of a black swan event? The opposite of a black swan event would be, um, steady growth, low energy prices, productivity growth picking up, innovations increasing innovation. Not innovation, innovations increasing productivity, low unemployment rate, GDP steadily growing, not too fast, but steadily growing, low inflation. Like those are just the conditions that are opposite of a black swan event. But I guess the opposite would be what happens after black swan, which is a massive increase in money supply, in credit, and lower rates. That's the opposite of a black swan event. But then that might result in inflation, is what we got in 2020 if you print too much. AMC, heck no. Oh, layer 2 for Bitcoin. Yep, know what you're talking about. All right, let's see. A white swan. How will BRICS affect the US dollar stock market? Hey, that's a good question. Let me show you something about BRICS. I knew somebody was going to ask this question. Let's look at the data here. Let me show you guys BRICS, and it'll be on YouTube because actually no, I might be able to. Oh, I can't pull this out because they only allow me to show it on mobile. So unfortunately, I can't really. Let's see. I might be able to screenshot this and then show it on YouTube. I can't click on the site. So let me pull this out really quick. Is there any way I can show this on YouTube? Somebody asked about BRICS. And I'm gonna explain that. I'm gonna explain BRICS to you. Why it's nowhere near. It's not gonna take over the dollar. It's just not gonna happen. So let me put this up for. So in blue, and I'm gonna try to get this on YouTube. In blue, if I can do this. Here we go. In blue is basically. Oh, that looks crappy, but we'll try to get to it. So in blue is basically the G7 countries, right? This is GDP for the G7. This is basically how big the economies are in the G7: the US, Germany, Canada, who is that? France, Great Britain, Italy, Japan, right? So you can see the GDP, the economies are much bigger for the G7 than the BRICS countries. The BRICS countries are very small. And this is what BRICS National Steel Trial G7 per capita GDP. So this is per capita. Okay, per capita. You got Russia, China, Brazil. So BRICS is not going to be a real threat, until their economies start to outpace the G7. So you need Brazil to outpace you. India is actually outpacing. India is growing quickly right now. India is growing fast, but they're still not where they could be, right? Mexico just passed Russia as far as GDP. So Russia's just an industrial economy. They can raise their industry. Their consumer economy is not there. Neither is China, but they can produce weapons very fast, right? Brazil has a big consumer economy. They export, meats. They export a lot of red meat, beef, steak, whatever. Russia exports weapons and commodities. China exports low labor. India exports software. Look at India exports, smart software engineers. And so, the US exports US dollars. The US really exports debt. So that's why this is why BRICS is not a threat, because all these countries are indebted by US dollars, meaning that no matter if they can't get off the US dollar. All they can do is try to circumvent they can only try to circumvent or get around the US dollar if they're sanctioned, right? So if they're sanctioned, they're going to try to get around the dollar because they can't make that trade. But most countries, the biggest economies on earth, are not sanctioned, right? They're not saying China is not sanctioned, Japan is not sanctioned, Germany is not sanctioned, uh, Brazil is not sanctioned. It is the fear of being sanctioned that they are worried about. So the US best weapon is the US dollar. But the problem is, all these countries in the world, most of the world, they don't want to be paid in Brazilian whatever. They don't want to be paid in yuan. They don't want to be paid in Russian rubles. They want US dollars, because the US dollar is the most stable currency. It is the strongest currency out of every other currency. You always hear that the US dollar is falling apart. That is a plain out lie. They lied to my mother, by the way. These damn fools. I'm sorry, I get pissed off because they be fooling people. That is not true. Let's go to currencies. Let's just look at currencies here. Okay, let's go to the currency. US China. Let's look at the long-term trends. And you tell me if the US dollar is falling apart. Okay, so this is US dollar versus China, the Chinese yuan, meaning if it's going up, it's strengthening. If it's going down, then it's losing its status, right? So if we go to 2022, the dollar is actually strengthening. It is not weakening. If you go to the trend, it's going up. Now this crap, I don't know what this is, 2005. Okay, who knows what that is? Either way, the dollar is strengthening, or you could say it's sideways, right? But the dollar is not falling apart versus the Chinese currency. Let's go dollar versus, oh, this is dollar futures. What is this? No, it's just dollar futures. Dollars versus Japanese yen going higher. The dollar's going higher. And right now, if you're a futures trader, Japan's about to increase rates, by the way. So if you trade futures, keep in mind that when you increase interest rates, what you're effectively doing is you're incentivizing people to go to that currency, to strengthen that currency, because they're going to get paid whatever the interest is. So Japan's what is it? The Japanese yen is actually going to be increasing in value because they increase the interest rate. So this should trade higher. No, this should fall. This should actually fall versus the dollar because we're headed to cutting rates. Japan is increasing rates. So we're going to cut the earned interest on the dollar. They're going to increase the earned interest on the Japanese yen, right? So they're going to increase the value. We're going to decrease the value. But anyways, yeah, the whole point is no, the dollar is not falling against other currencies. How about the dollar versus the euro? Well, for a while it was falling, but you can see that it's actually strengthening over the past, 10 years, 13, 15 years. It's strengthening versus the euro. How about the dollar versus the Brazilian real? Is that what's called, the Brazilian real? Yep. And that real actually comes from Spain because Spain and Portugal colonized the South America back in the 1500s, and they were called the Spanish real. So they got the Portuguese language and the Spanish language over there. I'm a history nerd. But anyways, yeah, look at the dollar. The dollar strengthening against the the Brazilian real, the Russian ruble. It spiked and came down, but now it's moving higher again. And net, it's going higher against so the dollar is not falling apart versus these currencies. That is a false narrative pushed by freaking doomsdayer gold bugs most of the time, who say the dollar is going to collapse, hyperinflation. There is no hyperinflation. Other countries' inflation is much higher than the dollar. So, and the reason is because they just print currency a lot more than we print. It's just a false narrative. How about the dollar versus the Canadian dollar? Nope, strengthening. False narrative. This is the actual numbers. Okay, this is the only currency the dollar's not strengthening against, the Swiss franc. Yeah, that was it. It's not strengthening. So it's been weakening against the Swiss franc. I don't know why. So yeah, be afraid of the Swiss. No, I'm just kidding. It doesn't mean much. I mean, our economy is probably 10, 20 times bigger than the Swiss economy. Oh, that's the US 30 years. So my point was, hey, the BRICS ain't doing nothing because most of the world it's all about world trade, and most of the world, their debts are in dollars. Therefore, if they were to default on their debts, the dollar goes much higher. Let's see if I can simply explain that. Because they owe dollars, if they default, that means they remove the amount of dollars. And if you make something more scarce, if you remove dollars from the system, you make the dollar more scarce. If the dollar is more scarce, what is supply and demand? If it goes higher, it goes much higher because you're removing the supply of dollars. And if you remove the supply of water bottles in the desert where people are thirsty, the water bottles become more expensive. So that's just bullcrap. How will BRICS? Yeah, okay, yeah. So BRICS ain't doing crap anytime soon. It could happen in 10 years, but it probably won't be BRICS. It'll probably be digital currencies, a basket of digital currencies tied to gold or tied to, should I say it, Bitcoin? I don't know. It'll be tied to something, and it won't weaken the dollar. It'll just keep the dollar sideways. But other countries print, they're more close to hyperinflation than the US. Just a false narrative. Dollar dying from debt, not other currencies. Well, the dollar's measured, Mr. Jamier, the dollar is measured against other currencies. So the dollar, if other currencies are printing debt faster than the dollar still stays higher. So yes, the dollar is dying. That's why Bitcoin's up. That's why stocks are up, because you're reducing the value of the dollar. That is true, but versus other currencies, which is the case here we're talking about, versus BRICS currencies, the dollar is strengthening, right? So in itself, yes, the dollar value is going lower. That's why we invest, because Bitcoin is strengthening, stocks are strengthening, and the dollar is not. The currency is not strengthening. But versus other currencies, no, that's not the case. Macro global economists, let's go. Yeah, let's go. Meta. Super cycle, white swan. Yeah, okay, look. But we own more. I'll do a couple charts. Let's do a couple charts. We're already at an hour and 45 minutes. This was long, but let's do a couple charts. Just throw your charts out. I'll do a couple charting before my brain poops out. Let's go. What was I looking at? I was looking at, well, Coinbase exploded. We talked about Coinbase and AMD. They made a gigantic move. Let's see. Yeah, Coinbase is rocketed higher. So if it ever comes back to this trend, that'll be a nice, like, honestly, if what I'm looking at is if Bitcoin rips back to like 55K, I might get calls on Coinbase because it's gonna go up. It's gonna go up, and you're getting that retracement. And now the Bitcoin bull market is here, right? The liquidity cycle is on. The rocket ship has left. So a pullback would be nice, but right now it's up too much. Hood does look really good. It's going to be benefiting from all the trading because trading is back. So Hood, did it get that pullback? It got the pullback consolidated. The move already happened. Maybe a move back here for Hood. I'm looking at Okta though. This is a cybersecurity play, and it had a gigantic gap up. I'll just show you a couple of charts. I'm looking at big gap up, and it is now consolidating at this level, kind of held this level. What is this? 107, 108. That would look good. I mean, that one looks pretty good if it can hold. It has to hold this level. So Okta's looking pretty good. AMD, I'm going kind of quick here. AMD, oh, okay. AMD is looking good. It's starting to pull back. Okay. AMD had that big move higher. Now it's starting to come back a little bit. I think AMD is going to be good for a while. It's coming into the trend. You can clearly see it coming into this long-term trend. I mean, 184, 185 would be nice, but AMD is pulling back into the trend and the market is strengthening. You just got to be patient for AMD. You got to be patient. It might form another base like this and then move up. Rumble, I don't know what Rumble stock is. Tesla short term is really hard to tell. I think Tesla's going to slip again. It looks like it's going to slip. What's it at? 169. It looks like it wants to slip down. So this is the weekly. Let me pull down the MACD. This is the daily RSI. What I'm looking at, the next signal for Tesla, in my view, is going to be this weekly RSI coming right back down to where it did in January of 2023. That'll be extremely oversold. I made a video when this happened. I said Tesla's extremely oversold, and I got a lot of views on it, but we're just not there yet. And the reason I said that is because most people think it's going to go to zero when it gets, extremely oversold, but it's really a lot of financial engineering to shake out the weak hands. And does it come back to this level? I don't know. It looks a lot like it did in 2019 when I first got into Tesla. This happened. It was moving higher, and then it had a bad earnings, not good as expected, and it came all the way back down to where it was 3 years ago. And that's what we're looking at today. We might come down, and the RSI went on the weekly down to 30, and it bounced because it was just oversold. It's still the best EV company in the market. I mean, it's Tesla. It's wild. And the growth projections are going lower. So we need China to come back online. You need Elon to, start ramping up the $25,000, what is it, the Model 2. You need better deliveries. There's a couple things you need. You need margins to increase. You really need interest rate cuts. This is my guess. Going into June, if the Fed cuts in June, I think Tesla's going to rip, because once you lower rates, now the cost of financing a car is lower. And what's going to happen is investors are going to say, okay, now the cutting cycle is here, so we can project that demand for EVs is going to pick up because the prices are lower, and they're really going to be lower for people who are financing it because the rates are coming down. So I think Tesla's going to bottom pretty soon. I thought it was gonna bottom here. I thought it was gonna bottom here. I was wrong twice, but it had a bounce, didn't happen. I said 185. No, it was 198.50 that it could not hold. I got out 198.50. So I trade it. So I'm not like this is why I don't talk about it because I mean most people are not going to trade. That is just way too hard. But I'm looking at this oversold at this oversold weekly. When it gets down there, I think that's the signal. I'm actually looking at leap calls. If it's not shares, I might look at some leap calls because I believe in Tesla. You don't have to, but I believe in it. Um, Short term, yeah, I think it goes lower. I think it's gonna have a nice sharp downside move lower. Could come into like 150, and I'm watching that RSI. Apple stock. Let's see, Apple stock, AAPL. What do you think's the next catalyst for Chainlink? Hard to say. I mean, it has a lot of partnerships, but the next catalyst might just be I think the catalyst is here. I don't know, bro. I really don't know. I think to me the catalyst is here. I mean, Chainlink's up what 200%. It was at $5. It went up to 10, 15, 20. So I would say Chainlink is still really strong, but it ran before the market. So I think on the next Bitcoin pullback, Bitcoin consolidates, and I think Chainlink makes its move higher. It might come down to 17, might break all the way back down to 17. But I think I think the thesis is in place. It could be, a positive, it could be an increase in volume for transactions on CCIP. I don't know. But I'm in it for the long run. Um, Apple stock. Apple's pretty oversold. Once it gets down here, it'll be pretty oversold. This chart looks disgusting. But yeah, Apple is Apple. I mean, it's holding VWAP. It's holding this anchored VWAP. I always use the anchored VWAP. But let me see, 165. I don't know. Apple, what does Apple look like? Let's go to the daily. See if there's any support on the daily. This looks like the support zone, 166. I'm going to say it has to hold 166. If not, probably comes down about 150. I'm going to say 166, then 150. If the market, rolls over, but right now the market is still pretty strong. There could be a rotation back in Apple. I really don't know. I'm not interested in Apple, but it's not going to disappear. I'll tell you that. Maybe the SMA. Let's see. Is there any simple moving averages? I think the anchored VWAP is your best bet right now. It has lost upward momentum at the moment. So I'm going to say upward. I'm going to say anchored VWAP. What about that 200 weekly? Turn on this 200 weekly simple moving average. See where it's at. Okay. So here's your 200 weekly around 150. At most, I think Apple goes down to 150 at most. And it would be a good buy for a long-term investor. I mean, Apple ain't going nowhere. Not my first pick, but maybe 150, 155. Be patient, or nothing at all. It's hard to tell because again, the closer we get to June, I think I think we need a correction. I want a bigger correction. That's what I want. But it doesn't matter what I want. It matters how the market digests the future macro. Where's inflation headed? I'll tell you right now, unemployment is ticking up and it's a lagging indicator. So we probably get to 4.1% unemployment. That means interest rates come down, which is going to be a tailwind for the market. Payrolls are still accelerating. So if anything, what's happening is employment is employment is weakening in some sectors, but it's strengthening in other sectors. So it's called a rolling recession, if you want to call that a recession. So I think everything to me fundamentally looks really good. It just comes down to picking your spots. I think it's just picking your spots. Could SPY dump tomorrow? Yeah, SPY looks like it's going to finally roll over a little bit, but it's hard to tell. I mean, it's still pretty vertical, and it's still holding the 10-day weekly moving average. That's the momentum. That's the momentum level. Let's take this off, and I'll point this out. So SPY is just moving up, but look at the Qs. Watch this. The Qs are actually starting to wedge here. Right, the Qs are wedging. They're still holding anchored VWAP. So I'm still bullish on the Qs because they're holding this anchored VWAP from the previous correction. Still holding. If we get under and if we close below, let's say 437, then I might get bearish on Qs. But right now, it still looks strong to me. The market kind of shrugged off the CPI. It's still falling. Core is still falling. So it kind of shrugged it off, whatever. Link price target. Let's go. I'm going to say I'm going to say somewhere between 100 and 200 for Chainlink. But like that's like blow off top. 200 is like blow off top, like crazy, perfect macro, right? But I think it gets to about 100. I think Link can 5x from here. Netflix. What else we got? Apple Advanced Auto Parts. Oh, AAP. My bad. Advanced Auto Part. My bad. Over here doing Apple. Okay. Advanced Auto Parts. Well, this looks like it's recovering. My bad. Who is that? Erika Digi. Sorry. I always do that. Let's see. Well, I'll tell you this. It does look like a recovery. Advanced Auto Parts. Why would it be recovering? Why can't I find my tool? Oh, here it is. So Advanced Auto Parts. I mean, cup and handle, right? Cup and handle. It has a lot of strength. It is picking up momentum. Let's turn on that simple moving. Oh, yeah, this thing has momentum. This has momentum. So I like Advanced Auto Parts. I would want to see, me personally, I'd want to see a pullback, obviously. It's up a lot. Here's your breakout point. So it's trying to break out here. I would say you want to see Advanced Auto Parts. I mean, it could just keep going up, but it has momentum. Maybe a pullback into this yellow EMA. Is this the EMA? No, this is a simple moving average. This is like the 10-day. This is a 10-day moving average. So a pullback into like 75 and a hold. You want to see that it's breaking out, retest, maybe a hold right here, which is that previous support. I'm sorry, previous resistance, 175-ish. And then maybe you don't go all in if you're doing share. It really depends, right? It's always different. But what I would do is I would get long maybe like one tier here. If it breaks out, I want to see another pullback, get long the rest of my tier 2, if I'm going 2 tiers. I mean, I wouldn't be chasing this stock because I don't know what it does. I don't know what the future is, but it has momentum. You just want to pull back for sure. They probably beat earnings. Looks like they crushed earnings. Oh no, they had a downside surprise. I don't know. See, I don't know. I don't know the fundamentals of this, but it does have momentum. Netflix, Spy, Toyota. Have you looked at Mara? No, not yet. Netflix is hosting that Mike Tyson fight, right? Man, Netflix is just vertical. Looks like some bearish divergence. I'd watch out for Netflix. It looks like it's going to break down. You just never know. Some of these tech stocks, there's just so much demand. They might be pulling away with the market share. What a recovery by Netflix. I'd still want to wait for a pullback, maybe into about 550. Maybe about 550 if it can consolidate around 550. The consolidation is a reflection of buyers holding the level. So I wouldn't chase it, but I'd wait for this level to hold somewhere around here in this previous bar. 550 to like 570. And it kind of did something right here. It did something similar to that right here. But yeah, I've never liked Netflix price action. Let's see where the trend's at. You see the long, because if the market does, look, if we get a correction in the market, a lot of these will just come back to, they'll come back to gravity a little bit. They'll pull down a little bit. So I don't know. I would be, it's hard for me to be optimistic on some of these that are up too much, like Nvidia, Netflix. I mean, Netflix is a monster. Look at that. Goodness sake. I just don't like to chase. I wouldn't chase. But if you are looking at Nvidia, still holding anchored VWAP, still holding that anchored VWAP, this is your support about 840, 830 to 840. That's your anchored VWAP for, let's do the Netflix. Hey, make sure you guys give a like. We've been on the stream for 2 hours. I'd appreciate it. All right, so Netflix. Let's go from this pullback. Yeah, about 590. It's holding anchored VWAP. Looks pretty good. What else do we get? SPY. PayPal is just bleh. SPY still holding anchored VWAP. I wouldn't be bearish on SPY unless it dropped 509, 510. But SPY looks strong. S&P looks very strong. The thing is, the rally is starting to broaden. It's broadening in a bunch of other stocks. A lot of stocks above their 50-day moving average, 20-day moving average. So the rally is starting to broaden. Let's see. Let me double check exactly how many stocks are above the 50-day moving average. Yeah, this looks strong. And this is basically, let's take off the log. How many stocks are moving above the 50-day moving average? We're at 77. 77% of S&P 500 stocks are moving above that's very bullish. That's pretty bullish. We're getting rotations back and forth. But you are getting I guess the dollar is slipping. The 10 years moving up a little bit. I'm pretty bullish. Apple, PayPal, if you care to. I did Apple already. TSM, somebody said. Nice pullback on TSM. Is this at all-time highs yet? Not. Oh, I guess it did. TSM looks good. Break and retest. Break and retest right here. I wouldn't trade it, but it looks like it's on trend. Here's your trend, right? Oops. Yeah, TSM looks pretty good. Probably pull into this trend. I mean, if it came back to like 135, it'd be nice. Support at 135, TSM. PYPL. Running out of brain power. Man, PayPal is just struggling. PayPal looks good though. I mean, it's been struggling at this trend, but it probably shook out all those options. Everybody was buying call options because they're like, PayPal's the best technical setup in the market. It's gonna move up because trading is back, crypto is back, so PayPal should do well. Once it gets above this long-term trend, I would wait for the break in the retest, and it should be good. I mean, it should be good, huh? Like it's easy, like it's that easy. Not that easy. I would say for PayPal, you could get. I mean, I want to wait till this has been in a big downtrend, so I'd wait for the downtrend to really break. You don't want to get stuck in this chop. Just chop, chop, chop. Oh, fake out, fake out, fake out. Chop. No, you don't want that. You don't want that. Wait for it to break out. Once it gets above this previous high, like 68, it should break and retest. And who knows what that looks like because every stock moves different. I don't study PayPal, so I don't know. But if it does happen to get up here and get rejected, double top makes a new low, or it could come up, breakout, retest. This is where you want to see if it holds this level. And then now you're out of that big term trend. You're out of that trend. Now you move higher. Yeah, I wouldn't buy options on PayPal unless you like. That's just some of these. The theta is going to eat you up. Like I said, Mara. Okay, I'll look at Mara. I mean, Mara is pretty much Bitcoin. Let's get this back to a log chart. Mara is pretty much Bitcoin. I'm gonna do this is the last one. Then I'm gonna go over Chainlink. Okay, last one. Then I'm gonna go over Chainlink. Mara. Look at Mara's pulling back when Bitcoin's going up. I don't really like that because if Bitcoin does have a correction, this thing's gonna get ripped. So really, you're waiting. This is kind of tricky because you got to wait for Bitcoin to correct or break out. And you're looking for Mara to support the previous support and the previous resistance, which is somewhere in a range between 19 and 15. So it has a big range. So I'd say for Mara, if Bitcoin rips lower and Mara can support this level, that'd be a good level to get long off, as long as it doesn't drop 1550 and close below that. If Bitcoin breaks out and Mara is still down here, then maybe you can get long this level because it'll catch up at some point. Does it have earnings? You got to look. Does it have? This is why I don't like these, because they have earnings and something could happen. Let me see. I bet you there's earnings. Oh, it just had. I probably had. Go look at the earnings. If it had something wrong, go read the earnings report. Go YouTube Mara earnings. You better go figure out what it is, because this is why I don't like these proxy bets, because of their earnings. Right? They're still companies. They're not ETFs. So yeah, I don't know. But it has to hold 1550, maybe even 19. I don't know. That's tough. You're better off getting Bitcoin ripping lower first and then finding out where the level starts to support on Mara. Clean Spark is a good miner. I don't even know about that. Have you ever had a leap option payout? Yeah, I got a leap option back in the day on Tesla. I'm actually looking to do leaps. I don't know. I don't want to say what I'm doing. I'll just give you the easy bread right here. I'm looking at this. I still think this is the best price action in the crypto market. It's only a matter of time. Look at this trend. Look at that beautiful trend there. The only one that looks better than this is probably Solana. Solana does look really good. But Chainlink is about to, well, I don't want to say it's about to break out, because if I could tell that. But it is supporting the RSI, the midpoint, still holding that RSI. If it gets below, it's probably going to come back. Is this Chainlink's market cap? Oh, cool. So we're looking at the market cap. Now, Solana's like 30 billion, so I think we can get up here, but that doesn't really tell you price. Either way, I do like this chart better than all the other cryptos. I'm going to end with Chainlink here. It's already been 2 hours, 2-hour stream, way too long. The algorithm's going to crush me. This is too long. This is not a podcast. But yeah, I've been tracking it. I think next stop for Chainlink, if it can keep holding the $20 level, is 27. And then if it gets back to the 50% return, or the golden pocket is around 35. So I think we can hit 35 around the halvening, April, May. I don't know for sure, but I think once it launches, it's going to launch. And it's been front running the market. So it's just tricky because Bitcoin's up a lot, and we've seen a couple of rotations. Maybe the rotation comes the end of this week, who knows? But I like what I'm seeing here. Those are your two parts, 27, 28. And again, like I say before, Chainlink has the best fundamentals in the market. Has the widest reach out of all cryptos across all of the crypto market. DeFi cannot work without Chainlink. It is locked in, price feeds, connecting all the blockchains together, connecting connecting, Swift, DTCC, Euroclear. This is getting institutional adoption. And if you go to G-Link, check this out. This is crazy. This is another reason. If you go to G-Link, I'm going to look it up real quick and then throw it on the screen. Watch the price of G-Link. This is the Grayscale Trust, and this tells you that there's a lot of institutional adoption for Chainlink. Let's see if I can find it here. I need a chart. Okay, here it is. I'm gonna put it on the screen. So this is Chainlink versus G-Link. Now remember, there was a Bitcoin Trust, GBTC, and it lagged behind. Look at the institutions cannot buy Chainlink outright yet because it's not a commodity, but so they're buying G-Link. They're getting exposure here. The price went up to 200. Got up to was it 200, or am I lying here? Okay, got up to 170. I thought I saw 200 somewhere. Got up to about 170, and Chainlink is down here at 19. So what does that tell you? Institutions cannot get a hold of Link, so they're buying it through the gates. They're buying higher prices like crazy. That tells me if there is an ETF at some point, maybe not till next year, there's going to be a large rotation. This will eventually balance itself out, and Chainlink is going to soar. So when I look at this, I just say, okay, Chainlink's headed for about 170 at some point. Is it a promise? No, it's just a bet. It's just my opinion. But there's a lot of institutions interested in Chainlink, and that's why I'm long, and that's why I'm interested. I'm not going to push anything else other than Bitcoin, Ethereum, because I don't understand the other coins. I think a lot of them are full of crap, and a lot of them promise a bunch of stuff they can't deliver. This coin, I don't want to call it a coin. It's an infrastructure is delivering. It is actually delivering. It is the future underlying the next generation of assets. The tokenization of all real world assets, treasuries, stocks, all that. They're going to tokenize. They're going to move it. They're going to move all these assets, cryptocurrencies, stable coins. They're going to move them onto blockchains. We're not talking about crypto. We're talking about private blockchains. JP Morgan, Citibank, they've already done it. The whole system is going to be tokenized on a blockchain, but these blockchains cannot communicate. So they need CCIP. They need proof of reserves. And this is not like a whole, I have to do a whole, I want to do it clean, but I'm just kind of throwing it out there. Basically, proof of reserves is this is the only software. Is it software? How do I say this? This is the only service that actually can prove that something is true on chain in real time. Proof of reserves. Nobody else has it. There's not another crypto who has proof of reserves except for Chainlink. So it's going to be implemented in the global financial system, right? Swift is the biggest network in the world for banks, and they're using CCIP. So once this narrative comes mainstream, I think it's over. I think it's lights out, and Chainlink is going to go to the moon. I think it's just getting started. No, I don't have a crypto ledger. I'm holding it in Coinbase. I'm not like a crypto maxi like that. I do have a ledger, but I'm not putting it in that ledger. I trust Coinbase right now more than my ledger. Maybe in the future, but I don't really see it. I don't really see it. I don't need to do a ledger. Maybe if I was a criminal, I'd probably do a ledger. I don't know. So yeah, I'll leave you at that. Look at the institutions want Chainlink. It's coming. It's just not a popular. They don't market all over the internet and say they're going to the moon. They educate you. Go watch the Chainlink channel. Educate yourself. Don't say I didn't warn you. It was at $5. I made a video. I said I'm buying more Chainlink. I'm going all in. Now it's at 20. My bags are up 3x. I don't know if I can do this. I want to show my actual trade because this is the biggest trade, but I don't really want to show it because I don't know if it's going to mess up my image. No, I'm just playing. No, I'll show you if you guys want to know. I'll probably post it on my newsletter. I'm not going to put it on YouTube or TikTok because that could be, classified as trying to induce or scam people, blah, blah, who knows. But it'll be in my newsletter. I'm going to show it on my platform, not on these platforms. I'll show you how much I'm up on Chainlink if you're interested, so you can see I'm not full of crap and just saying it, right? Because I go all in. When I go all in something, I do the research, I go all in. Anyways, you guys stay blessed. As always, stay healthy, eat healthy, lift weights, learn something new every day, stay blessed, fitness, finance, and faith. Do what you got to do to improve every day. Appreciate you guys on the channel. I'm going to cut this up at the beginning. And you guys have a good day. Stay blessed. Make money. Get some sleep also. Appreciate you guys. Thank you. Oh, I'm still